The rules just changed. Most people haven't updated their playbook yet. Crypto tax is about to change forever, and 99% of crypto investors have no clue what is happening or how it will affect them. New reporting rules, a new tax form, and a brand new way the IRS sees your portfolio, all going live within the next 12 months. I know this because I've been building TokenTax since 2017. We file crypto taxes for traders, DeFi users, and high net worth investors every season, and our team sits inside of this data every single day. When the IRS changes a rule or an exchange flips a switch, we feel it before most people even read the headline. So in this video, I'm going to walk you through the 5 biggest shifts to crypto tax that I see happening over the next year. I will show you exactly what is changing, why it matters for what you owe, and the move I would make in each case to stay ahead of it instead of cleaning it up in April. Let's get into it. For most of crypto's history, taxes ran on the honor system. The IRS asked, you answered, they mostly had to take your word for it, and that era is over. Starting with 2025 transactions, centralized exchanges are required to file Form 1099-DA directly with the IRS. Coinbase, Kraken, Gemini, basically every major US exchange is now in that reporting pipeline. What that means in plain terms, the IRS already has a number for what you sold before you sit down to file your return. This is exactly what happened with stocks decades ago when brokers started issuing 1099-Bs. Before that, stock gains were largely self-reported too. Then the forms arrived, the data started flowing, and the IRS had a baseline to compare your return against. Crypto just crossed that same line. The mismatch problem is where this gets serious. If the gross proceeds number on your return does not match what your exchange reported, that discrepancy is visible. Not theoretical, visible. That is the kind of thing that generates notices. So the move here is straightforward. Before you file, reconcile every exchange account against what they are going to report. Do not wait till you have the form in hand. Know your numbers first. This one catches people off guard because it does not show up on any form. You feel it when you try to file and the numbers simply just don't add up. Under the old rules, most people track cost basis in kind of a universal pool. You bought ETH on Coinbase, bought some more on Kraken, and when you sold, the basis could come from that combined pool regardless of which account the sale happened in. That is no longer how this works. Basis is now tracked wallet by wallet, account by account. If you sell crypto from an account, you must use basis from that account. Universal pooling is gone. Here is why that matters for a real trader. You buy on one exchange, you move it to a self-custody wallet, you sell from there. The IRS expects you to show exactly where that asset came from, what it cost, and how it traveled there. The chain has to be clean. Every transfer between your own wallets now needs to be recorded. The basis has to follow the asset, and that chain has to stay intact. Buy on Coinbase, move to a ledger, bridge to another chain, sell on a DEX. The IRS expects to see every step of that documented. So this is where spreadsheets begin to collapse. The rule is simple. The cost basis has to follow the asset. The hard part is proving that across years of transfers, wallets, bridges, and exchanges. If the record is incomplete, you can end up in one of two bad places. You cannot prove your cost basis and overpay tax, or you use the wrong basis and underreport without even realizing it. So the move is get every wallet and every exchange under one reconciled view before next tax season, not the week before the deadline, now, so you're not reconstructing history under time pressure. The biggest misunderstanding is simple. No 1099 does not mean no tax. So 1099-DA covers centralized exchanges. It does not cover DeFi. Your DEX swaps, LP positions, staking rewards, lending activity, none of that is being reported on a form to the IRS. No exchange is filing a 1099-DA on your Uniswap history. That sounds like good news, and it's actually the opposite. The reporting does not disappear. Swaps and LP exits still need to be calculated and reported on Form 8949. Rewards are still income valued at when you receive them. The difference is that no platform is handing you a clean form for it. Here's what changes. Once centralized exchange activity is reported more consistently, the gaps in your return become easier to see. If a reported exchange shows assets leaving Coinbase for a wallet, that is not the end of the story. Your return still has to account for what happened next. The swaps, the bridges, LP positions, rewards, and sales that happen outside of the exchange. Now, the 1099-DA may not report the DeFi leg, but it can can establish the starting point. From there, an incomplete return is harder to defend. It's the same principle as reporting a salary while leaving out freelance income. The reported income gives the IRS part of the picture. The missing activity is what raises the questions. So here's what you do. Treat DeFi reconciliation as the highest priority item in your portfolio, not the lowest. The instinct is to tackle the easy stuff first, exchanges with clean exports. Flip that. The activity without clean forms is where the risk is. There's one structural advantage crypto traders have right now that stock traders do not. And I want to be direct about the fact that it may not last. Under current law, the wash sale rule does not apply to crypto in the way that it applies to securities. For stocks, if you sell at a loss and buy back the same position within 30 days, the IRS disallows that loss. For crypto, that restriction generally does not apply in the same way. So that's why tax loss harvesting has been more flexible in crypto than it is in stocks. But do not read that as a free pass. If a transaction has no real economic substance or it looks like a paper loss created only for tax purposes, the IRS can still challenge it. A few things to understand clearly. First, this does not apply to everything. Crypto ETFs are treated as securities, and the wash sale rule applies to them the same way it applies to stocks. The carve-out is specifically for underlying digital assets, not every wrapper around them. Second, proposed legislation has attempted to extend wash sale treatment to crypto more than once. This is not a niche idea. It keeps coming up. The direction of travel is clear. The current window exists because the rule has not been extended yet, not because policymakers have decided crypto should permanently be exempt. Third, clean records matter here more than people realize. The strategy is only as good as the documentation behind it. If you are harvesting losses without being able to substantiate the transaction history, the basis, and the business reasons for the trade, the benefit is only theoretical. So the move is, use the current window deliberately this year, but do it carefully. Map your unrealized losses, know which positions you could harvest, and keep a clean transaction record behind it. Also, do not assume the window is still open in the next congressional cycle, and make sure not to think every loss is immune from IRS scrutiny. This last shift is operational, but it changes everything about how you actually manage taxes as a crypto investor. The old model was trade all year, figure it out in March, pull the exports, run the numbers, deal with whatever you find. That model has two problems now. First, once the 1099 DA arrives from a crypto exchange after the year end, the IRS receives the same reported amounts from that platform. Your return needs to match those amounts or explain the difference. An extension can give you more time to file, but it does not make the cleanup easier, and it does not give you more time to pay what you owe. Second, wallet by wallet basis tracking cannot be reconstructed cleanly from historical data when that history is incomplete or ambiguous. The longer you wait, the harder the gaps are to close. But the reason to shift to real-time tracking is not just to be defensive. The real advantage is on the planning side. An investor who knows their tax position throughout the year can make tax-aware decisions all year long. They can harvest a loss deliberately when a position dips instead of noticing it after the recovery. They can see whether a planned sale triggers short-term or long-term rates before they execute. They can manage the size of taxable events rather than letting anything happen. An investor is still doing the March scramble is always in reaction mode. They find out what happened after the fact and look for ways to offset it. That is harder, slower, and more expensive than doing the planning on the front end. The move. Set up real-time transaction tracking right now. Treat tax planning as a year-round operation. The filing window becomes a confirmation step, not a discovery one. So, pulling all of this together, here is what the adapted investor looks like going into the next filing season. Every exchange account is reconciled. When the 1099 DA arrives, it matches with little to no intervention. No surprises. Basis is tracked wallet by wallet from the point of purchase. When assets move between your own accounts, the basis moves with them, so the transfer does not get mistaken for a sale. DeFi activity is reconciled with the same rigor as centralized exchange activity. The gap is closed before anyone looks for it. Tax loss harvesting is used deliberately, with documentation while the wash sale window is still open. Tax planning happens throughout the year. The deadline is when you confirm the numbers, not when you first look at them. That is not a more stressful version of crypto taxes. That is a less stressful one, because none of it is discovered at the last minute. If this is useful, drop a like on the video. There are a lot of crypto investors who are going to hit the next filing season without any of this context. The more this reaches them before that happens, the better. Now you know the 5 shifts. The next question is what to actually do about them. Specifically, what moves still work under these new reporting rules to bring your bill down legally. Click this video right here. I walk you through 3 strategies crypto investors are using right now to do exactly that. All of them designed for the reporting environment we are actually in. I'll see you there.